Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Really appreciate all the comments and support, and of course the subscribers. Today we're going to look at Alphabet. Obviously that's Google, the absolute giant in the search and advertising space, as well as a host of other very interesting kind of moonshots as they call them. We're going to look at the cash flows in the business and come up with what we think the intrinsic value of Google is, or Alphabet. We're going to call it Google from now on, and compare that to the market price and see what we think the economic return can be by holding Google over the next decade. And of course, as always, this channel is dedicated to the cash flow investor, the value hunter, the individual that is not looking to speculate, but is looking to put hard money against cash flowing assets to keep that cash flow. And we do that by looking at 5 key attributes for all of our investments as the beginning, as kind of a foundation under which to consider an investment. And those are going to be top line revenue growth, earnings growth that we define as Ebitda, enterprise level earnings, free cash flow growth, strong balance sheet, meaning no debt or less than 3 times Ebitda debt, and 5 is a well-priced stock. And by price, meaning earnings to enterprise value as a ratio, not the dollar in the stock market as it trades. As a note on that, please, if you're watching this one, watch my video on the Domino's versus Google IPO. Had you held Domino's for 15 years, when it IPO'd the same year Google IPO'd, Domino's return actually beats Google. Shocking, right? I know, I was blown away when I saw it too. The reason why, you could have bought Domino IPO dirt cheap because nobody cared. Everyone was like, it's a pizza joint, But over time, that stacked up. They bought back shares. You reinvest your dividend, and then they have recently grown with their app. This is Domino's, and the share has exploded. And you would have returned, I think, something like 5,000% over the last 15 years. Google, no slouch. I think it was like 3,000% or something like that. But you paid a little bit more for it when you bought the IPO, so that held back the return. So, of the 5 key attributes, I would say the biggest one you could do is not pay too much for growth, and that's what we're going to look for. Let's dive in. So behind me is the 10K for Alphabet. It was filed December of 2019. Here, this video as of September 2020. So there's a good 9 months of actuals, kind of post-COVID, that are not reflected here. But we're going to look at a good swath of history and take a look at what Google has been doing historically and what we think it could do going forward, and if it warrants the price that is in the market, and see what that looks like. Okay, let's dive right in. I liked, obviously, the Google IPO, the 10K. Let me get my notes here. I like the breakdown that they provided. There's a couple things that I want to call out here quickly. Page 24, it breaks down their revenue by sector, which was very nice to see. Let me build this up for you. So a quick snapshot of 2019 being on the far end, where their revenue was, where they derive it from, and obviously their advertising base from the just Google engine itself. Big next step is YouTube and all the ad money that they get from YouTube, and then kind of down the stack networks and cloud and other services to give you a whole round picture of where they derive the revenue from. Long story is it's obviously mostly search. The next page is 27 that I wanted to show you, and this was just a geographic breakdown to show you where in the world you're getting most of their revenue from. 40% being in the United States, 46 in the US, 31 in the EU, and then 17 in the Asian Pacific coastal region. So strong global diversification, which is good to see in this era of the dollar and where we might go with the United States. So it's nice to have revenue streams coming in from a basket of currencies around the world. That would help if there's any kind of inflation pressure going forward in the United States with the dollar. You would have then strong foreign dollars being converted into a weak U.S. dollar to help bolster those earnings. But I liked that. I like reading through the 10K. Definitely suggest you read the 10K. It's very important every single year. to see where the business is going, but also just get a good snapshot of the business. Let's go through quickly the financials. I want to just show you, I think it's 45. Yeah, so here is the consolidated comprehensive income. Super clean and easy to read. Great start as a 10K if you're just digging into this. Start here and then branch out into some of the more complex 10Ks, but it's very clean the way they do it. This would actually be consolidated cash flow, not income statement. My fault. Consolidated balance sheet, income statement. Here it is. So there's your 160. So right there, $161 billion of top line revenue. Costing down to the bottom, $34 billion of net income. And for our purposes, when we look at EBITDA, we're going to build up from net income. We're going to add back taxes to get $39 billion of EBIT, earnings before interest and tax. There's no debt, so it's EBIT. And then we'll add to that depreciation, and they have a gain on a sale that we'll remove, and you'll get their EBITDA number. We'll cover it in a bit. But I just want to show you the P&L is super clean. Also, the other thing I liked is the balance sheet. They have a tremendous amount of jack on hand, in case something happens. Marketable securities right there. Marketable securities. I hope you can see this. It's pretty small. $101 billion of hard cash sitting in the bank, just waiting to be spent. They don't pay a dividend, and they make a ton of jack. So this stuff is just accumulated in the balance sheet. They're going to have to do something with it, and I wouldn't be surprised if they start declaring a dividend to pay this out, because it is getting. Large is just a side comment at this point. That is absolutely gargantuan, $101 billion. But they make a ton of jack, and the principal point here to show you the balance sheet is that current assets can cover all liabilities. If I look at total current assets, right there, total current assets, $152 billion. Scroll down to total liabilities, $75 billion. So plenty of money to cover all the obligations. Kind of a Benjamin Graham stamp of approval right there. But that's not why you watch the show. I just lost my monitor. Hopefully it clicks in. There it is. That's not why you watch the show. You watch the show to go over the financials. Let's go over the financials. It's back. Let's hope it stays. All right. Revenue $37 billion in 2011. It has grown to $161 billion of revenue. That is a 20% annualized top-line revenue growth rate over the 8-year period of time, which is absolutely outstanding. I mean, that if you think of the 5 boxes, revenue growth being one of them, definitely checks that box. And it's like clockwork. Every year it's been growing. Outstanding. Kudos to that team. Ebitda, the same thing. Again, we were looking at net income plus interest plus taxes, add back depreciation, and then you get this stream, $14 billion to $48 billion every single year. Boom, boom, boom. It's just going up like 16% on annual. It's amazing. There's not much to say other than that. Then kudos to them. So the first 2 of our 5 boxes is definitely checked with solid double-digit growth rates. Let's check debt. That's gonna be quick. It's gonna be 0. And then let's check valuation, which is really what we want to do. So debt here, $3 billion to $16 billion last fiscal year. That's a joke with them having $100 billion of jack on hand. So what I've done is I've netted out, so it's just 0 is the debt. So that's a stamp for us of really a good approval. That 4th box that we look at is the company over levered. The answer is definitely no here. So now you've got revenue growth, check. Earnings growth, check with strong double digit. We've got no debt. Let's look at valuation. So if I take debt less excess cash plus market cap went from $180 billion to just shy of $1 trillion, $926 billion. Add those up, less the cash, gives me an enterprise value. Enterprise value is the entire organization all together. And when I look at that trades historically, so that enterprise value divided by the EBITDA that they have, you've got a 10 to maybe 20. It's currently at 20 times EBITDA. So you're kind of like a 10 to 20 range that this trades in. 10x for Google obviously is an absolute steal. 20% isn't too rich, in my opinion, for double-digit revenue and earnings growth with no debt. And it's not cheap, but it's kind of a fair price, frankly. When I look at some of the other FANG stocks and where they're trading with the most current Ebitda to enterprise value, you can see Google is actually the cheapest of all of them. Well, Facebook's right there at 20 times, but Apple 23, 24x, Netflix 57 times earnings, no thanks. Amazon's 40 times earnings, no thanks. Facebook is 20 times, kudos to them. And Google's 20 times. So I think here, if I'm comparing like the true growth stocks that everyone's raving about, why pay literally twice as much for what is good growth? Don't get me wrong, Amazon is definitely crushing on growth, but so are these guys. And they're basically half the price of Amazon. So, I mean, there's no subscription model here, I get that, but it's still solid growth. So I think that checks the box for us. Top line revenue growth, yes. Ebitda growth, yep. Let's look at cash flow. Let's look at cash flow for a change on the actual consolidated cash flow statement. Income, cash flow. Let's go over the cash flow statement. Here it is. So cash flow, we begin with cash flow from operations always when we look at our schedule. And we're going to pick that line up right here. Cash flow provided by operating activities, $54 billion. We're going to go up to our cash flow statement right there, $54 billion. So this number has grown from 14.5 to $54 billion over this 8-year time plan, 18% annual growth rate. We smell check that with the Ebitda growth rate of 17%. That is an accounting check you want to always do. That makes sure the P&L, the income statement, is growing in line with the cash flow statement. You look at some companies, I'm not going to name names, but you look at some companies and they'll show you razzle dazzle in the P&L, but when you look at cash, it's not there. That's because the P&L gives, under GAAP, it's totally legit, under GAAP allows management a tremendous amount of flexibility with how they recognize revenue and how they recognize costs. That's how they can massage the numbers to hit earnings targets every year, to show a net income that is real in terms of GAAP, but it's not cash. And what we buy is cash. So you always check that. So cash flow is smell checking, growing at 20%, outstanding. It's growing at 18%, outstanding. The next big box we want to look at is Capex. Now, Capex is the investment that Google has to make to maintain its current system. It's not Google going out and buying Fitbit or buying another company. That is an acquisition. That's a different cost. This is just the expense to maintain what they have and to keep kind of a levelized growth rate that they've been experiencing. And you can see here in the cash flow statement, if I come down to the second third, right, this double line here is the first third. You've got the middle third, which is the investing section, and you'll see purchase of property and equipment, $100 billion. Did I get that line right? Purchase, that's marketable securities, excuse me, that's the wrong line. $23 billion. $23 billion is the investment they made in infrastructure and growth for their business. So then we come in here and we plop in $23 billion. So we know that from cash money they generated, from operations, they generated $54 billion. God, I love saying that's a lot of money. Less what they had to put back in the business. They gave back for reinvestment 23. The net of that is $30 billion. So at the end of the year, they had literally $30 billion of jack just piled up. And they're like, what do we do with this? I don't know. So they just stick on the balance sheet. And that's how they have $100 billion sitting there. Because they're not paying down debt, they have no debt. So that 30 flows right through to cash flow that you and I as investors are buying. This is what Google's valuation is based on. And you can see this has grown every year really nicely. Okay, so we just went through cash flow from operations. Now let's move forward and talk about the shares outstanding and the yield on Google. So we covered shares are flat. Shares have gone roughly 1% up over the period of time. And I've had to make some adjustments for when Google was Google before it was Alphabet. I have reversed the share split they did and shown kind of reflecting the normal shares outstanding historically for that change. And what you'll see is basically 1% growth rate on the shares outstanding over time against super strong cash flow. Gives us cash flow per share starting at $18 a share in 2011 and growing to $44 a share in 2019. Against the average share price for the month of December gives me a yield. And the yield has gone from 6% down to 3%, averaged 4%, which is a strong yield for such a growth company. You would think that that yield would be a whole lot less as people pay up for that growth, but they're simply not. Okay, let's recap. What do we have? We've got top line revenue growth, strong double digits. It's 20-something%. Let's see what it was. 20% right on the nose. Strong EBITDA growth. EBITDA is our measure for earnings. That's 16.6% growth. Strong free cash flow growth. Excellent. No debt. Fantastic. And well priced. It is. It's 20 times earnings, so it's not cheap. I would call it fair. Maybe a little high, but it is fair, especially when you look at some of the other competitors and where they're trading on the FANG metric, not competitors in the true sense of the word, but more like other high-flying growth names in the stock right now. Google seems to be very fair. So let's go forward and forecast and see what we have. So what I'm going to do is I'm going to pick up this $48 billion of Ebitda and I'm going to grow it going forward. So $48 billion growing at 16.6%, and I'm basically going to drag that forward, slowly bringing down the company as growth, as it grows, growth should slow. And you got $56 billion, it grows to $150 billion of Ebitda. I'm giving that a 20 times enterprise value handle for such a monster company. It should have a pretty sizable handle. That's a $3 trillion enterprise value. If essentially no debt, I hold cash constant, that gives me $3 trillion of a market cap, less the shares outstanding, gives me $4,400 a share, or almost $5,000 a share for Google, based on an EBITDA market multiple approach. Okay, now let's look at cash flow and we'll get a second value measure for us. So here, same thing. I'm pulling the free cash flow that we're experienced, $44.50. I'm taking that number and I'm growing it at the same rate of Ebitda because cash flows Ebitda is turning into cash and passing through. Those two should grow in line together. So I get $51 and change, and that grows to $138 over the time. And when I give a 2.5% yield to this, and again, 2.5, it's currently at 3 and change. You can't see this. It's currently 3.3. I think it deserves a little bit more of a premium given the size, and it'll come down to 2.5%. When it does, that's a $5,500 share price. Pretty lofty, but I think justifiable given their historical growth rate. So now we have two growth measures. We've got a cash flow based and a market multiple based. We're going to average the two and come up with an approximate guess at 2029 price target. 5,500 based on cash flow, 4,500 based on EBITDA market. We're going to split the difference and call it $5,000. So now what is the stock trading at today? It's trading at $1,500 a share. I'm saying that Google, given their historical growth, given no debt, given the huge cash store they have on hand, I think they could continue to grow as they have been, and even bringing down the growth rate over time as they get bigger. That puts a price target easily, using two different methods, around $5,000 a share 10 years from now. If I put that into an IRR, so here's the $1,500 share price that you buy in at. Here are cash flows. Now, Google doesn't pay any of these out. It's retained, but it's still cash on the balance sheet that is yours as an owner. And should they decide to dividend out, you're going to be getting that. Also, if they buy other companies, they could use that cash to do so and hopefully grow even faster. $5,000 long-term share price gives you an an 18% IRR over that time period, or almost 4 times your money. So that is a IRR, or internal rate of return, for Google over the next decade as they continue to perform as they have been. The growth forecast is a little heavy. It's starting at 16%, 17%, but I do bring it down over time. Roughly 1% degrading over the time. And it's basically 3 times the Ebitda. If I go back and show you, this is basically 56 billion to 150 billion. That's growing at threefold over the decade, which is a strong target. But they've been doing it in the past, so I kind of want to give them credit for it. If I put this into a distribution, like I have in the past, and show you what it would look like, let me see. So here's our 18% currently IRR. If the price goes up to $2,000 a share, it's still an attractive buy at 14%. That's still a market-beating return over a decade, assuming the forecast holds the same. But if the price should fall for some reason down to the $1,200 to $1,100 range, then the return is even more attractive. So for this channel, we're going to give it a good. Why? Again, let's recap. Strong top-line revenue growth, strong earnings growth for a lot of years. That's been really doing. No debt, tremendous cash on the balance sheet, and it's moderately priced. It's not cheap. But given the amount of growth that they're experiencing, given what the market is pricing other growth stocks at, I think if you're going to put money to work, certainly in the FANG area, this is definitely one to do. So I hope you liked the review. My name is Cameron Stewart, CFA. This is the review of Alphabet, also known as Google. Please comment, subscribe. Let me know what you think. Let me know what stocks you want me to do next, and I'm happy to take those on. My name is Cameron Stewart, CFA. Thank you very much.